Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Mark Warrior, manager of the BlackRock UK Income Fund, to give his 3 stock picks. Hi Mark.
Morning.
So what's the first company today?
Well, the bank sector we think is very interesting at the moment, and it's an area we've been increasing in the portfolio this year. So companies like Lloyds has been a share that we focused on. And I think the sector is interesting because you've gone through this horrendous period of bad debt write-offs, PPI insurance claims. That's now coming to an end. So essentially, in a bank like Lloyds, you have a very cash-generative, very strong deposit-taking franchise. And the cash flow that it's now going to be generating is going to be able to be distributed to shareholders. Also, the regulatory environment is, while it's not great, it's becoming less bad, and that's important for a share that trades on a pretty low PE multiple and a pretty low price-to-book multiple.
You say things like PPI are coming to an end. I was listening to the Today programme this morning and they were saying even more fines expected. Do you think it's just a drop in the ocean for these banks now, and actually, even if there are further fines, actually it's not going to affect things like the dividend?
Yeah, I think it's just really the scale of the liabilities that we're looking at going forwards. 5 years ago, we were looking at multi-billion-pound liabilities, and I think the fines and those types of conduct costs, they can be accommodated in business as usual expenditure. So I think that's the key change, and the companies consequently have got more visibility in terms of how much capital that they can now distribute to shareholders.
And what's the second company today?
Well, it's a company we've held for a long time, Next, which is, I'm sure, a familiar company to everybody who invests and everybody who shops. But I think it's a great example of a company that's operating in quite a difficult environment. The UK clothing market is not without its challenges. But because the company has a very low cost base, it's been on the forefront of growing its online business through the directory. It's a very high return on capital business. And what's turned a good investment into a spectacular investment is what the company has done with that cash flow and what it's done with its balance sheet. So if you go back to the year 2000, the company has returned over £3 billion in share buybacks over that period. So an earnings growth that perhaps running at 5 or 10% has been running strong double-digit because they've shrunk the share count, they've been very disciplined with capital, and they've rewarded shareholders rather than through diversification or over-expansion. So a company really focused on shareholders, and that's what we like to see.
So many retailers have fallen foul of e-commerce, but Next has seemed to get it right. You've mentioned you've held it for some time. Is Next a sort of stock that you could go on holding forever and ever? There's never a sell trigger with that sort of company?
Yeah, obviously, if it became very expensive, if the PE multiple started to go into the 20s, we would re-examine it. But at the moment, it's still trading on a free cash flow yield, which is the metric we really look at, of about 5%. And for a company with such a great long-term record and a dividend yield that's still very attractive, we think it still stacks up.
And what's the third and final company today?
Well, it's a company we bought last year, Carnival, which is a cruise line operator. A slightly more controversial holding in that this has been a poor investment really for the last decade. The company have had a lot of self-inflicted problems. But a new management team took over last year, and we think they're gradually turning it around. And a bit like a cruise ship, it takes a long time to turn around. But if you look at the airline industry, and if you book a flight with EasyJet, the flight tends to become more expensive as you get towards the departure date. The cruising industry hasn't worked like that for the last couple of decades. There's been too much stock that's been left to sell at a low price at the last minute. What management are doing now is starting to change that mentality. So better yield management, more facilities for better onboard spend. And for a company that's trading close to book value, there's a lot of gearing there in terms of share price performance if the management pull off that restructuring.
And how reliant is that company on the UK economy? Because also, obviously, it's more pounds in the pockets of the consumer means more pounds to spend on things like cruises. Obviously, we are in quite a comfortable place in the UK economy, but interest rates could change that. It could mean less money in the pocket for individuals because they've got to spend more on their mortgages. Are you keeping an eye on that?
Yeah, it's a good point, and I think all consumer companies, we need to think about this because we're now in quite a mature phase for the UK economy. But the great thing about Carnival and the cruise industry is it's really the grey pound that drive that industry. And actually, rising interest rates, for many pensioners means higher income, so more discretionary spending power. So it's one of those few consumer players that could actually benefit if the interest rate environment changes.
Mark, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.